Hi traders, and welcome to my private trading library. In this video, we're going to look at everything that we've learned, including chart indicators, trade psychology, market makers, and the options chain to evaluate a trade and how to pick which options to trade. Here I've got an example stock, Comcast. We see that the market price is $57.21. We see that there's a market maker move. On the monthly options chain, our implied volatility is 2.41, and our put-call ratio is less than 1, meaning that there's less puts than calls. So that means there's more calls, so that means the sentiment is up. Now let's look at the chart. On the chart, I've got my voodoo lines, which are historical lines of support and resistance, the squeeze pro, and the stochastic RSI. On this side, we have sequence counter, we have the 8 moving average, 21 moving average, the ready aim fire, and the MACD. Now, what are these things telling me? We have a bottom reversal of the price action. Our indicators are indicating seller exhaustion and a reversal. So what that means is anyone that entered a short position will want to buy to cover and close their position in this area. You're running out of sellers. So you're getting some buying pressure from short sellers closing their trade. And on top of that, you're getting dip buyers stepping in to buy this dip. And so you have double buying pressure occurring at this level. So what I'm thinking is going to happen is that this double buying pressure will cause an upward push on the price candles of the stock. Now, how do we know if that's going to just continue going up or hit some level of resistance and turn back down? Well, then I'm going to look at the stochastic RSI. Now, the stochastic RSI is telling me that we're getting close to another level of being overbought. So that means the upward momentum is going to run out of steam at some point because we're already close to an overbought position. So what that's telling me is that it is not going to continue in an upward trend. Most likely it's going to hit some level of resistance somewhere in here and then test it and move back down. So what levels of resistance do we have? Well, we do have the 21 simple moving average here, and then this is a voodoo line at about $60. On levels of support, we've got the dip, which is right here in the range of maybe $54. So let's keep those numbers in mind, $54 maybe dollars here and $60. Now, looking at the options chain, we're going to look at the monthly, and this number here, as we had discussed in our previous video on options chain, is the implied volatility priced into these options. Now let's calculate our upward range of anticipated movement on Comcast. We're going to bring over our calculator, and we're going to take the market price plus the implied move. So that's going to be 57.21 plus 2.412. And 59.6, well, it's basically $60. Why does that number seem familiar? Well, if you remember on our chart, that was a pre-established level of resistance. So what that means is market makers people that take the opposite of every trade believe that this stock, Comcast, will trade no higher than $60. So when we're picking options to trade, it might be smart to trade in the $60 and below range if you're going to be going long. So if we were to take a trade, you could go with something like a Delta 70 option, which is in the money. And so we covered that in a previous video. What that means is for every dollar that Comcast moves up, that the price of this option will go up by $70. That's a lot. And if we had established that the upward trading range of Comcast was $60, that's a $4 range. So 4 times 70 is $280. So if you were to buy a fixed $56 strike option, and it did happen to go to $60, that you would make quite a lot of money off of that. So that's one way to do it, is to buy a Delta 70 call. Another way you could do it is buy an at-the-money call. So that would be something like the 57.5. And in fact, a lot of traders apparently do that. And that's okay too. And because what's going to happen is, as Comcast trade moves up, this option, which is currently out of the money, is going to become in the money. And then its price delta will actually increase. And so you can make a lot of money that way and pay a little bit less for the option. And then a different way to do it is to buy the upward range of the trading range. So you can see that a lot of people in fact do that too. They're going to buy the $60 call because the price will move up into this range here. Now a more dangerous way to trade is here, out into this way out of the money range. The reason I think that's dangerous is, yes, you're using a lot of leverage. You're buying calls at basically $5 or 5 cents per contract. But it's possible that the price action, it's trading at 62.5. It's very possible that the price will not go that high. So whoever bought those options going up into this range, I'm not convinced that the price will go in that range, because we've got this negative kind of sentiment. Now what sometimes this is, sometimes that's that could be a leg of another option, like a vertical option. It can also sometimes be a hedge against an opposite trade. So for example, if let's say an institution was short this in this range, they're going to want to offset their loss by getting these options, paying something cheap, so that as this moves up, it offsets the loss on this side. So sometimes this is a hedge, or sometimes it's the other leg of some other option. Now looking at the volume here, 55, 60, you could also do something called a butterfly option. It's a little bit more advanced, and I do some butterfly trades sometimes. So the way that you would set that up is go to spread, butterfly, and you're basically going to profit on the first leg of the butterfly. So if you think that it's going to go to 60, then that's the one you want to buy because it's going to stop at 60. So you're going to press buy, but you may want to increase the wings of the trade, maybe to 55 and then equal on the other side, 65. And so what happens is you're going to buy a butterfly spread for $2 or $200. But because you're buying, you're going to profit from the price being above 55, but you're also going to profit from the price being below 60. So it's basically two spreads in one trade. And that's why you can pay very little but profit quite a lot. Let's see what our profit would be on a butterfly spread. So our maximum loss would be $200, and our max gain is almost $300. So that's how that works. Now I'm going to delete this order and see what it might be if we were to trade a vertical spread. So go to the menu and press vertical. There's two kinds of spreads. There's a debit spread that you buy or a credit spread that you sell. Well, since we're taking a long position, we can try to buy a spread. So what you could do is you could still buy the $55 strike, and then you're going to offset the cost with the $60. So we can try to buy the 55, but here, since we know that the price will probably go to 60, we're going to buy the spread and profit from the entire movement here. You're going to buy it for $218 or $2.18 per contract. And our profit is $282 if it goes to $60. So I'm going to delete that. A different way to trade that is to sell a credit spread, and it would profit by being above a certain number. Now, if you recall, our area of support was something like $54. So we would want the price to stay above $54. So when you go to your options chain, you're going to sell something in this range like right here, $54. $54 here, selling the 54, and then now look at the number here. You have very poor profit to risk ratio. You're going to earn $7. You're going to risk $93 to make $7. So that particular trade doesn't make sense. Let's see what happens if we fiddle the numbers a little bit and just change the numbers. Now, even taking the spread out a little bit further is still not that great. So we would risk almost $470 just to make $32. So when you do it like that, you can already see that it doesn't make sense to sell a put credit spread. I'm going to delete that. So in this particular instance, it makes more sense to either buy a vertical debit spread that will profit from movement from a support level up to an area of resistance, maybe $60. You're going to profit from that movement. Or to buy a single leg option of either a Delta 70, or you could buy an at the money at 57.5, or a riskier trade would be to buy the $60 strike, where the volume and open interest are, because it's the upper level of resistance. So there's a number of ways that you can trade that based on your risk tolerance.